Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. The United States Congress has passed legislation to end U.S. President Donald Trump's tariffs on Canadian imports. The vote marks a shift for the Republican-led House and signals growing anxiety over the White House's economic agenda before midterm elections. The U.S. president is likely to veto the bill, meaning it won't become law. Shares of Mullen Group are seeing a decline. They're down more than 9% right now after the Canadian trucking and logistics company posted a drop in profits and missed estimates. Mullen says it is operating in a soft economy with overall demand remaining below previous levels. One bright spot, however, the company beat on revenue driven by acquisitions. Shares of Sun Life Financial have hit an all-time high. It's up more than 4.5% right now to 92.05. That was the latest number we have for you. This after the insurance company reported revenue in its most recent quarter that exceeded estimates and also posted underlying profit that beat expectations. The quarter was boosted by strong performance in its Canadian and Asia segments, as well as improvement in its U.S. unit and wealth management business. And turning to the markets right now, you can see the TSX, after a little bit of green to start the day, quickly has gone into the red, off by nearly a full percentage point, by 0.85 right now, dipping below 33,000. South of the border, the numbers again, similar situation. Everybody in the red. S&P 500 off by 0.6 almost. The Dow down, and the NASDAQ is off by more than a full percentage point. Now, gold remains in and hovering around record territory, trading above the $5,000 mark U.S. despite a slight pullback. It's hanging in right now, still up there, even though it's off today by 0.28%, but in and around $5,084 an ounce. All this following strong U.S. jobs data. Let's get more now from Rick Rule, President and CEO of Rule Investment Media. Rick, thanks very much for joining us.
Roger, thank you for having me.
It's a bit of an interesting day. We saw the stronger than expected jobs numbers yesterday, but the markets are off today. Gold's off a little bit. Your thoughts on where gold is right now? Where do you see it heading?
I think the fundamentals for the precious metals market are very much intact. Gold has done well historically, and I use gold to refer to the whole precious metals category. When people are concerned about the maintenance of their purchasing power in conventional savings instruments, fiat currency denominated savings instruments, I think those fears are very real. Debt, deficits, the unsustainability of entitlements, the citizens' expectations on both sides of the 49th parallel relative to society's ability to afford them tells me, sadly, that precious metals will do well for 10 years. When I say sadly, I mean the reason that they do well is usually because of the softness or weakness in more conventional savings and investment assets, a trend which I think continues. That notwithstanding, the gold and silver prices have moved very, very, very quickly in the last 18 months. And I think the pause that you've seen, in fact, some of the decline that you've seen is normal and necessary if we look at past bull markets.
First of all, what gives you the confidence for 10? You say 10 years you can see gold rising still and precious metals?
Yeah, I don't see any resolution of our fiscal problems. I don't want to speak to Canadian numbers because I'm not Canadian. But in the U.S., the on-balance sheet obligations of the U.S. government exceed $39 trillion, while the net present value of U.S. entitlements is $120 trillion. The combined number, $159 trillion, when juxtaposed to the private net worth, the total private net worth of the American citizenry at $167 trillion, tells you how perilously close we are to being unable to afford the level of government that we have. The alternative to that, I think, is really a slow motion default, a default that takes place by lowering the real purchasing power of the U.S. dollars. There's an analog for this. In the decade of the 1970s, according to the U.S. Office of Management and Budget, the purchasing power of the U.S. dollar declined by 75% over 10 short years.
Wow.
Not surprisingly, the gold price increased 26-fold in those 10 years. By the way, Roger, I'm not suggesting that the gold price goes up 26 times from here.
I can't even do the math on that right now.
The resolution of our inability to afford to spend at the pace that we're spending, the resolution of that has to be either a default, which I don't think happens, or a decline in the purchasing power of the U.S. dollar. And I think the latter is likely. I think the U.S. dollar will do okay relative to other fiat currencies, but I think it will do absolutely poorly. And I think as a consequence of that, gold and silver will do relatively well.
And when you say relatively well, I mean, obviously not. When it was 36 times, I think you said the gold increase in that decade. We're not expecting that, but where do you see gold heading?
It would not surprise me. I'm too old to give you a numerical guess. It would not surprise me to see the nominal price of gold mirror the decline in purchasing power of the U.S. dollar. If the U.S. dollar declined in purchasing power by 75%, a twofold or threefold or fourfold increase in the price of gold over 10 years in nominal terms, I think is a reasonable expectation.
And if you're investing, if you don't have gold right now, is it still worth trying to get in?
Absolutely. I am not somebody who buys gold as an investment. I save in gold. I maintain liquidity in U.S. dollars, which means that I have been periodically accumulating gold really since the year 2000. I wouldn't encourage somebody to go all in on gold at any point in time. I would urge people to understand that this is a core savings product. It is a medium of exchange that's simultaneously a store of value, unlike other currencies.
All right, and let's just quickly shift before we run out of time here. Let's get your thoughts on some oil right now, Canadian oil, investing in that. Where are your thoughts on that?
Oil is one of the few unloved commodities left. The U.S. oil industry is priced at a discount to its net present value at $60 oil, and the Canadian industry is selling at a discount to the U.S. prices. The challenge in Canada, of course, is political. The Canadian political elites for the last decade have been hostile to the most efficient industry in Canada. The recent exchange in Ottawa between noted Canadian oil analyst Eric Nuttall and an MP for Quebec is telling. The Quebec MP said that he doesn't understand how it's in the public interest to build out oil and gas infrastructure. And Mr. Nuttall responded that he should be aware that the entirety of the equalization payments that keep Quebec afloat comes from oil and gas. That's the nature of the political discussion. If the political discussion in Canada begins to revolve around solvency, then the Canadian political elites become much more accommodative to Canadian oil and gas. The Canadian oil and gas industry is selling at a discount to the U.S. industry. It has more undeveloped locations than the U.S. industry does. And Canadian talent, which is to say the human resources around oil and gas, is absolutely world class. The stage is set for a real rebound. The only risk left is political.
Okay, we'll have to leave it there. But Rick, thanks as always for joining us.
A pleasure. Thank you for having me back.
Rick Rule is president and CEO of Rule Investment Media. Up next, McDonald's ends 2025 with higher than expected sales. Our next guest will break those numbers down. McDonald's is reporting fourth quarter results that beat estimates for both profit and revenue. The company says its value menu, along with promotional products, have been key drivers of growth as it heads into 2026. The CEO remains somewhat cautious, though, noting the U.S. market still faces industry-wide challenges. To break all this down, we're joined by Matt Todd, Retail Director at S&P Global Rating. Matt, thanks very much for joining us.
Good morning. Thanks for having me on.
All right. Overall, is that a good value deal, the McDonald's report?
Right. So talking about the quarter, comp sales, comparable sales were 5.7%. And they also had positive guest counts globally. And I think this is notable for two reasons. So comp sales are exceeding the overall QSR market. Quick service is QSR. So McDonald's value-based offerings and strong global brand are clearly faring well. Also, McDonald's is getting more guests into the door. So I think that's really important in this current market. Customers are dining more frequently. So in addition to the value that they're offering, it's limited time offerings like Monopoly, and that was in the US, and the Grinch offerings around Christmas, that likely helped them gain share from competitors in the quarter. The company also, I thought, really highlighted their reach in the quarter, their scale, when they mentioned their sock promotion, because they said for a week they were the largest sock seller in the world. In the quarter, they're also lapping a fourth quarter in 2024. So this helped a little bit. They were lapping a quarter where they had food safety concerns a year ago. Mm-hmm. So that helped a bit for their comp sales, mostly in the US. But overall, I think when you look at that result, it was pretty solid. And then just on the profitability side, I think that was fairly consistent in the quarter. That kind of tells me that they're continuing to invest in the business, and that the discounting is not really eating into margins too much at this point.
Yeah, was it the value deals that drove the increase, or is it the economy right now? People are just simply looking for a cheaper meal, and that may change when the economy improves.
No, that's a great question. I think the reason we have a high opinion of these QSR operators, fast food, and especially these franchisors, is they have a very resilient business. In good times, their core customer, which is lower income, tends to eat there more frequently and spend more. In tougher economic times, they start to see the trade-in or the trade-down from higher income consumers. So that's, I think, what we're seeing right now. The company actually talked a little bit about their core consumer actually rebounding a little bit in the quarter, and I think they attributed that to their value menu starting to kind of reestablish their reputation in the quarter. And they continue to hit on that throughout the call about how important the perception of value is for their brand. So I think that, more than maybe the low-end consumer recovering economically, I think it's more their value offerings are starting to resonate.
And then from the global perspective, you said that was up as well?
Global was up, and I think something we were looking for there was they have a very strong association globally with the United States, and we were wondering if there was any anti-American sentiment that could hurt McDonald's results abroad. It didn't really seem to be materially affecting them. We saw pretty solid growth internationally as well. They're opening many new restaurants, accelerating that into 2026, trying to hit 50,000 restaurants by 2027 still. So it looks like international market's still solid, and really that tells me that both, again, the value is resonating with consumers globally, and they have market-specific promotions that are working well at the same time.
And are those ambitious, the 50,000 restaurants by 2027? You think that's achievable?
Definitely achievable. I think they've outlaid their plans for 2026 and accelerating from 2025, which was an acceleration from 24. So I think they're a well-established executor who knows how to get things done. And really, their ability to open restaurants really depends on their being economically, a good prospect for new franchises. So the fact that they're able to accelerate that in the most recent year is a good sign. It means that it's still profitable to own a McDonald's franchise globally.
And with customers, I mean, there's been talk about changing eating habits with the diet pills or diet injections and all those things affecting all that. Is McDonald's adjusting, or could this be a headwind for them?
Yeah, that's a question we've been hearing about the whole consumer food space, restaurants. It's hard to piece it apart to say definitively that GLP-1s are hurting the restaurants. I think regardless, restaurants are going to adapt. We've seen it with some of the brands really focusing on protein, adding more meat offerings to the menu. McDonald's has those on the menu. I think they probably, if they really saw it as a trend that they needed to address that was hurting their sales, they could bring in more of that. I think right now we haven't seen it.
All right, and the digital and loyalty scaling, you talk about they're looking to scale that up. What kind of an impact do you think that will have?
The digital is really important to their business. I think the digital hit an all-time high this last quarter. Part of that was aided by the monopoly in the U.S., where users who wanted to play Monopoly had to log into the app. But it was up 20%, and 90-day active users were also up 20%. That's 210 million users globally. And loyalty members and people using the app are really important to the strategy because they're engaged, they're on the app, and they're ordering more food per visit. Not only that, they're also going to the restaurant more frequently. So, and this isn't just specific to McDonald's. I think all restaurant operators, QSR operators are looking to get more folks on the app because they see this trend pretty widely.
And how's McDonald's doing with that compared to those other restaurants?
Well, I think those numbers speak for themselves. The growth in that they're exceeding and taking market share as well, both just in the restaurant but in the digital space as well.
Okay, Matt, we'll wrap it up there. Thank you very much for joining us. Appreciate it.
Thanks for having me.
Matt Todd is retail director at S&P Global Ratings. Up next, Waste Connections top profit estimates as margins expanded in Q4. We'll get more on that after the break. North American solid waste services company Waste Connections' latest results met revenue expectations and exceeded profit estimates. Let's break down the latest data with Noah Kaye, Managing Director and Senior Research Analyst at Oppenheimer and Company. Noah, thanks very much for joining us.
Oh, thank you for having me back.
Just quickly, a little bit about what Waste Connections is. I was kind of looking it up. I wasn't familiar with the name. Where are they based? They're based in the Toronto area, but is their focus across North America?
Yes, predominantly U.S. Solid waste and recycling operations with a minority footprint in Canada. But it's the third largest solid waste operator in the United States.
And GFL, I imagine, is one of them? Is it one of the top two? Or?
Yeah, GFL would be number 4. The top 2 are Waste Management and Republic Services.
Okay, and let's get into their numbers. What stood out for you from the positive side?
Positive side, I think there were a number of things. I think they beat the quarter, as you just noted, with really better margin performance. There's been very strong execution in core solid waste operations. Price cost spread has been favorable. That looks to be continuing. We're starting to see volume headwinds moderate. There's been a lot of self-help initiatives that have borne fruit. They've gotten down to record safety incident rates. They've gotten voluntary turnover down to target. Starting to do some really interesting things around AI and machine learning related optimization, some internalization of waste via network investments. And there is, I think, clear upside to the outlook from M&A. Management was talking about expectations for another outsized year of activity there and leaving a lot of room for any macro and commodities improvement. So those were all the positives that we took away from the quarter.
And I'm sure there's some negatives, but I just want to ask about the AI. How are they incorporating that? You said they were doing some interesting things.
Yeah, really a host of ways. I mean, a lot of this is about logistics, right? So you're running a fleet of waste collection vehicles. How can you route those dynamically to reduce driver time on the road, machine time on the road? How can you provide better service to the customer? That tends to lead to better outcomes, better pricing, better retention. In the sort of back operations, how can you kind of optimize your maintenance repair schedule? Really, this is a great example of AI being put to work in the physical world. And we think there's a lot of runway for that with the waste industry broadly, and certainly with this company.
Where else do you feel they can take that?
I think the commentary in the call was they've really started just piloting this over the last, call it 6 months, and they're going to roll some of these initiatives out more broadly to their fleet, which encompasses tens of thousands of vehicles. So there is a lot of runway there. We would expect it to show up really in better pricing, retention, and continued outsized margin expansion.
And is there room in this industry for driverless as well?
It's very interesting because the industry started talking about this possibility about 10 years ago. And of course, the reality of, a residential large garbage truck, driving down the community with nobody behind it, I think is enough to give anybody pause. What we are seeing is kind of the integration of, I would say, automation features broadly, having trucks move from rear loaders to automated side collection vehicles. So basically have a robotic arm, using more, I won't say driverless, but automation and driver aid features on the truck. So I think it'll be a long time before, on the road circuits, we see any kind of a driverless initiative. Perhaps at the landfill, there are some pilots there to do, driverless landfill compaction and bulldozing type operations. So I'd say runway, but probably nothing that your local community needs to be concerned about right now.
All right. And the stock is off today. I think the last number I said, I see almost 9%. When I looked, I just caught a glimpse at it. 7%. Sorry, 7% it's off right now. What are people not liking about this report then?
One key thing was the free cash flow guide for 2026 came in lighter than consensus. And there were really two factors impacting that. The first was the timing of CapEx for renewable natural gas and recycling projects. Those are going to come online and call it late this year, early 2027. That's a $100 million CapEx item for the year. The second was the remediation spend for a closed landfill in California. That's about $125 million. If you were just to normalize for those two factors, that means the company would be doing close to $1.7 billion in free cash flow this year. And the stock would be at this level trading at under 25 times price to free cash flow. That'd be the lowest valuation we've seen in the stock for 6 years. When we look at that, the relative valuation being at trough levels and recycled commodity prices being near trough levels, industry volume soft, there's a lot of trough elements to where the stock is trading today. And we think that makes for a very interesting setup going forward.
And any other headwinds like that, or more landfill closures or anything like that?
Nothing that's materially in the outlook. Certainly, with any of these companies, we're always keeping an eye on how they're managing their assets. But what we've actually seen overall is the companies are doing a good job retaining capacity for internalization of solid waste volumes. Waste Connections internalization actually approached 60% this quarter. So that's a big competitive moat in the industry, and certainly I think something that supports the strong margin performance and free cash flows you typically see from the sector. Okay,
sorry, when you're saying they're internalizing, what do you mean by that?
It means taking the waste that they pick up with the truck and bringing it to their own landfill, as opposed to bringing it to a third party's. Okay, so and that's obviously better for the bottom line. Absolutely. I mean, you're controlling through vertical integration the operations, your cost structure. It's a significant advantage for the large integrated solid waste companies.
Okay, Noah, thanks very much for joining us today. We appreciate it.
Thank you.
Noah Kaye is Managing Director and Senior Research Analyst at Oppenheimer & Company. When we come back, we'll check in with our own Andrew Bell. Kind of hesitant. I was actually down at the Canadian International Auto Show, and he'll be speaking with David Adams, President of the Global Automakers of Canada. Shares of Restaurant Brands International are in the red. The fast food operator reported revenue in its latest quarter that beat estimates, but investors seem to be focusing on the company logging lower profit compared to the same period last year. Analysts are also noting underperformance in same-store sales for Popeyes and Tim Hortons. Brookfield shares are moving higher. Total assets surpassed expectations in its latest quarter, while profits rose compared to the year before. The money manager says results were driven by record earnings from its asset management unit as well as growth in its wealth solutions business. Brookfield's operating segments also generated higher cash flows. Shares of GFL are down after the company gave a full-year revenue outlook that came in below what analysts were expecting. GFL's 2026 adjusted profit forecast also fell short of estimates. On the upside, the company revenue in its latest quarter beat consensus. And looking at the markets, it is an off day for the TSX right now. Suddenly turned. It's a bit of a sell-off right now. You can see it's off by nearly 2%, 1.88%. South of the border, it's not much better. Numbers pretty much the same. Concerns maybe they won't see rate cuts down there. You can see S&P 500 off by 1.1, the Dow down by 0.9, and the NASDAQ, look at that, off by 1.7. Well, Canada's vehicle manufacturing landscape has changed wildly over the past year as Canada copes with U.S. tariffs trying to shift manufacturing jobs south of the border. While production from American companies has fallen sharply in Canada, other international companies like Honda and Toyota have been better able to maintain their presence here. Joining us now, Andrew Bell, who is standing by with David Adams, president of the Global Automakers of Canada, and they're down at the auto show. Andrew.
Thanks very much, Roger. Yeah, you're dead right. In fact, incredibly, last year, 77% of the cars and light trucks produced in Canada were by Toyota and Honda. So I'm here with David Adams. He is president of the Global Automakers of Canada. Thanks very much for giving us the time. Your group represents Honda and Toyota and who else?
Basically all of the European and Asian auto manufacturers. So we have 16 member companies in the association. And as you said, our two manufacturing members responsible for more than 3/4 of the production in Canada. All of our members together responsible for more than 60% of all the sales in Canada, and probably the preponderance of electric vehicle sales as well.
You've been with the association for 21 years. Tell us about the changes you've seen in those 2 decades.
Well, I think you can sum it up in saying there's been more change that's occurred probably in the last 3 to 5 years than in the previous 15 years that I was with the association. I think just the change in technology from moving from an internal combustion engine to varying degrees of electrification, all of the advancements that we've seen in connected and automated vehicles, the technology that's been built into the vehicle now is truly extraordinary compared to what it was, even 10 years ago. So there's lots of changes for sure.
And on the manufacturing side, a retreat by the big US-based automakers.
Well, look, I think everybody has their time in the sun, I suppose, and I think that one of the things that I've been trying to do over my tenure with the association is to help advance the message that the ones that were the biggest producers at one point in time aren't anymore, and that frankly policymakers need to pay attention to those that have been here maybe not as long but are making a real commitment to Canada, and our other members who are considering making a commitment to Canada. So I think one thing that's sometimes lost is when our governments go on trade missions over to Asia or Europe, they perhaps sometimes neglect to talk to the Canadian offices that can help sort of grease the wheels with some of those discussions and dialogues overseas.
About getting possibly factories here, Korean factories, European factories?
Yeah, factories, that's always hung out as the panacea to get a motor vehicle manufacturing facility in Canada. But I think the reality is that all these things need to be looked at through the lens of most of the production, no matter who's producing the vehicle, goes to the United States. So the thing that we do need to get sorted out is our trading relationship with the United States.
Yeah.
So as long as that border is thick, as long as there are tariffs that are in place, it becomes a challenge for anybody making vehicles here to continue to do so in the face of tariffs. Government's done a good job at trying to offset those tariffs, and frankly, because we have the trade agreement with the United States, that the Americans have at least given credit for American parts that are in Canadian-built vehicles, which is offsets the tariff cost, but it's still an extra cost that anybody manufacturing in Canada has to bear to move their vehicles into the U.S. market.
Toyota itself has been quoted as saying the current tariff regime imposed by the White House over the long term would make it unsustainable to go on making cars in Canada.
Well, we'll see what the future brings. I think any automaker operates on a long-term planning horizon, and that planning horizon is usually longer than one administration. So I think the hope would be is that we can work with this administration to come to a better trading relationship in North America, because our argument has always been that the U.S. auto industry is stronger when it's incorporated with both of its Canadian and Mexican partners, and to be a more competitive industry overall to compete with the world. It's been a challenge to help the president understand that, and it seems to think that the best course of action is to try and repatriate everything to the United States. Challenge with that is, yes, you can do it, but it just ends up costing more to repatriate everything back to the United States. Global supply chains are global supply chains for a reason, because you get the best quality product at the lowest possible cost. That cost reduction can be passed along to the consumer.
In Canada, we've lost a lot of our production to Mexico. Mexico's seen its production rise. They're a lower cost country.
Yeah, well, that was an outcome of NAFTA for sure, is that we did see some of our production go down to Mexico. But I mean, I think the reality is that we're not going to get anybody in Canada or the United States, for that matter, to be involved in producing really labor-intensive goods like wiring harnesses and that sort of thing. So I think there are labor-intensive parts and components. A lot of that is done in Mexico, and I think the reality is that every regional jurisdiction around the world, whether it's in Asia, Europe, North America, there needs to be some low-cost jurisdiction to help the other components of that region succeed as a group together. So it's sort of the way that the world operates, I think.
Just on EVs, Honda has backed down or slowed down a major investment in EVs. Of course, they're not the only car company to do that. Right. Give us an idea, though, what is the production volume roughly of electric vehicles from those two big Japanese makers in Canada? Can you give us a ballpark?
In Canada at the moment, well, I think we're actually looking at more, from my two members, Honda and Toyota, at hybrid production as opposed to plug-in hybrid production. I think that will be the next step that follows. But I think and this is what we've sort of been saying to government for a long time on these issues, is don't prescribe what consumers have to buy by basically mandating manufacturers what they need to produce. So I think and the government has just announced an automotive strategy, and part of that strategy is to move away from what we call a ZEV mandate, so a prescribed target of EVs that manufacturers need to sell, to an approach that looks more at GHG, greenhouse gas emissions, which might not mean much to most people, but more fuel you burn, the more greenhouse gas emissions you create. So let's set a target for greenhouse gas emissions and let the manufacturers figure out how they're going to meet that target. If that target gets more stringent, then a lot of manufacturers, the only way they're going to be able to comply is to electrify. So I think that's ultimately what the Prime Minister is hoping is going to happen, is that if we set stringent but achievable targets, then the electrification will occur without having a prescribed mandate that was in place before last week's announcement.
Just very quickly, we're out of time, I'm sorry, but the government's proposed policy now is you'll at risk of tariffs if you're not making cars in Canada. What is the reaction of your group to that?
Well, I think the government's just simply trying to say, basically going back to Autopac days, if you want to sell vehicles here, then you should build vehicles here. So it might not necessarily be building vehicles, but it might be R&D investment. It might be doing some parts production. There's all sorts of different opportunities, I think, there for investment.
David, thanks very much.
Thanks, Brian.
David Adams, President of the Global Automakers of Canada. Back to you.
All right, thank you very much for that, Andrew. Andrew Bell's down at the Auto Show. Coming up, a shocker out of Vancouver. Former CIBC CEO Victor Dodig will be taking over as CEO of TELUS. We'll take a closer look right after the break. TELUS says longtime CEO Darren Entwistle will retire in June, with former CIBC CEO Victor Dodig set to take over on July 1st. The leadership change comes as the company reports fourth quarter revenue and earnings that came in slightly below estimates. For more on the story, we're joined by Christine Dubby of Bloomberg News. Christine, interesting decision. Retirement was short. I guess it was sweet. Now he's ready to work again.
Yes, Roger. I mean, this was a really surprising or eye-opening press release this morning. I covered telecom for a long time, and I covered the banks and just covered Victor's retirement, as you say. And this is sort of a worlds colliding kind of moment. It was very surprising for a couple of reasons. One, he was not an internal candidate, and companies tend to like to look for candidates from within to do an orderly succession. And second, he's not even from the telecom industry, although he has been on the TELUS board for several years now. There's some parallels people are drawing to the CEO succession at Scotiabank, where board member Scott Thompson, who was not in the banking industry at the time, took over as CEO. But there are some reasons that Victor Dodig would be a logical fit for TELUS at this time. It's really under pressure to improve its capital allocation and its balance sheet and win back investor confidence after some poor share performance over the past year in particular. And Dodig has a history of really turning around the operations at CIBC and dramatically improving share performance there. And he's also got a lot of experience dealing with large consumer bases, which both TELUS and CIBC do have.
All right, and I guess with all that, how does that tie in for the dividend and debt strategy for the company?
Yeah, very interesting. That's going to be the question on a lot of people's minds. Some analyst speculation today that the dividend is now more up for question because there was a sense that it was almost sacred under Entwistle and would be protected, and that perhaps it won't be given the same reverence under Dodig. He might have to make some more hard decisions about the dividend and about capital and sustainability of those issues.
All right, and then with Entwistle, is he done as of the end of June, or is he going to hang around for a bit?
So he will be staying on as an advisor to Dodig until next April, I believe. Many of your viewers will remember that this is not the first time they've tried CEO succession at TELUS under Entwistle. Joe Natale, who went on to become the CEO of Rogers, was briefly the CEO of TELUS in the mid-2010s. But at that time, Entwistle remained on as executive chair of the board. This time, he will be leaving the board as of June and taking the title of CEO Emeritus, but theoretically leaving a bit more distance between himself and the company. They're also very close in age. Dodig is going to be turning 61 in a couple of months, and Entwistle is currently 63. It's possible that this could be more of a transition role for Dodig, and we might see one of the operating heads take over in 3, 4, 5 years. So it will be interesting. I'll certainly be watching to see if this succession does stick.
All right, and we will be talking to you about it more, I'm sure. Christine, thanks very much for joining us.
No problem.
Christine Dubby of Bloomberg News. Coming up, Manulife has increased its dividend by just over 10%. We'll have more on that after the break. Manulife Financial beat on earnings estimates, delivering a record year and raised its dividends, but shares are under pressure. You can see they're down about 5% right now. Let's find out why. I'm joined by Mike Vinokur, portfolio manager and senior wealth advisor at IA Private Wealth. Mike, thanks as always for joining us.
Pleasure to be here.
Okay, so why aren't people liking what they're seeing today?
Well, It may not be that they're not liking what they're seeing. It may be that the stock has had quite a bit of a run since last year. Call it the $41, $42 level in September, October, and that's a 20-25% run in anticipation of good news, in anticipation of more buybacks, in anticipation of a higher dividend. And this may be just a sell on news type of effect.
All right, so let's break down the news. And what do you like about this report?
Well, we thought it was a pretty clean report. They beat the consensus earnings per share by, I believe, 6 pennies. They increased the dividend by 10.2%. You've got a LICAT ratio of 136%, which is quite strong. Manulife's got a very strong franchise in the 3 main geographic spheres that they operate in, being Canada, the U.S., and Asia. They did call out some still subpar performance, let's say, in their U.S. book of business that they're still working through, and that had sort of reduced their return on equity. But in general, a return on equity of 17.1%, that's quite strong. They had some ads in the general business. And also, what we like is the fact that they're able to comfortably raise their dividend, comfortably buy back 2.5% of their stock. We're at that point in the business cycle. Some may call it late stage. This is a great franchise, great company, great return on equity, and we think that earnings per share are going to hit $4.50 this year, maybe even close to $5 going into 2027. We think the stock is a really great franchise and one to own.
Okay, let's talk about the U.S. Does it look like the issues have been cleared up? Any more potential concerns there?
Well, they have a book of business there, and I believe it has to do with some long-term care policies that are legacy policies that were maybe underwritten a long time ago. They're working through the issues. I don't necessarily know that we're at the end, but from the tone of the report, it seems to me that they're much more comfortable with the risk that they're undertaking there than they were previously, and they're working toward getting that ROE, which I believe in the quarter was 10%, back up to a much higher level, sort of like their average main businesses in Canada and Asia.
And how about the other two, Mark? How's Canada doing? Any concerns there?
No. So we think that the what they call APE, it was down a little bit, but year over year was tracking well. They've got great margins that are tracking well. They've got great efficiencies. One thing that we will call out is that in their wealth asset management business, it looks like they lost something in the range of $10 billion. But when you drill down, it looked to us that it was mainly due to clients needing to redeem funds as opposed to necessarily losing mandates. And in fact, they actually added net inflows of $3.4 billion from some institutional business. So we think that, their institutional wealth management side is working quite well. The performance obviously is good if they're getting, some good net institutional money flows. And really, this is just ebbing and flowing in terms of a very big book of business that I think is north of $600 billion in terms of assets under management.
And then Asia, I think they've talked about that as the biggest potential growth there.
Yeah, absolutely. Look at the demographics. You've got a huge population base to work with. They did make some acquisitions on the money management and asset management side. Manulife is a juggernaut. They have a very strong balance sheet. They're able to keep on acquiring and make tuck-in acquisitions. They keep on, squeezing out cost efficiencies throughout the whole enterprise and just, bringing up that return on equity investment. And, we just think that this is going to keep on earning and chugging along and hopefully more dividend increases to come.
Okay, and just going back, the LICAT, I just want to ask about that. 136%, what was it before? And that's up in a good solid territory, isn't it?
It is. I think it was at 133 or 134. Manulife has been very consistent over the last, I'd say, call it 5 to 10 years in being over that 130 range. And that's a very, very comfortable zone.
And overall, any concerns? Anything you see on the horizon?
Well, there's always your business risk. Slowdown in the economy may slow down sales. Obviously, if the markets pull back, AUM will drop with the market, which will drop asset management fees. It's your typical life co type of business. But in terms of Manulife itself, we don't see any dark clouds. We like the business. We like the business mix. We think they've got a lot more growth that they can get to in terms of their Asian business. And hey, if they can fix the U.S. side of the business, the John Hancock side, well, my God, you could probably step up earnings by 20 to 30 cents a share, and that could add a meaningful impact to the fair market value of the share price.
Okay, we'll leave it there, Mike. Thanks as always for joining us.
Pleasure. Thank you.
Mike Vanoker is Portfolio Manager and Senior Wealth Advisor at IA Private Wealth. Market calls coming up next. Today on the show, we have Stan Wong. He is a Portfolio Manager at Scotia Wealth Management. He'll be taking your questions on North American large caps and ETFs. And just one quick look at the markets. They are not happy today. You take a look at some of these numbers, and we'll leave it on that. Maybe not even say anything about it. There we go. You can see TSX down by 2%, and the U.S. market's not doing much better. That is it for morning markets. Thanks for joining us. Look at those numbers. We'll see you tomorrow.